Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Noah Rosenfarb. Thanks for being on the show again, Noah.
Yeah, of course. Happy to be back.
Noah was just a guest very recently, show WS 645 on July the 27th. I would encourage you to go back and listen to that episode. But today we want to talk about some specific things that he's really become an expert in. He's able to provide a ton of knowledge today on some tax stances that he has and ways he's benefited by having things structured, maybe a specific way to lower the tax burden that I think will be beneficial to all the listeners. But a little about him, he helps the rich get richer so they can supercharge their impact. He started investwithourfamily.com, where you can see details about the 3,500 plus doors he owns across the country. He is a third generation CPA, founder of an SEC reporting company, LFIGIRoyalty.com, that acquires revenue-based royalties in internet businesses, and the chief investment officer at freedomfamilyoffice.com, where he advises entrepreneurs with a $20 to $100 million net worth. So Noah, welcome again to the show. Grateful to have you on and just, your willingness to share your expertise. Grateful for that. So, let's jump right in. And I know we're going to focus on some tax stuff today, and that you're going to just help enlighten us on. I know right off the bat, I want us to jump into just your stance on 1031. I hear that it's a little different, maybe maybe something that's not talked about on a lot of podcasts. So I'd love for us to just jump right in. But you're welcome to share any updates from the last show. I know it wasn't that long ago, if you want.
Sure. No, I think one of the takes that I have that is somewhat unique is around Section 1031. And, it's very common for people that begin investing in real estate to utilize that tax code section, which enables them to roll into a new investment without paying any capital gains tax on the sale that just took place. That's really advantageous. And I don't want to take away from the advantages that it can provide to investors. Another great advantage, especially when clients are older, so let's say they're in their 80s, maybe even approaching 90, and they want to exit an asset that requires some time and attention for them, and they don't have that effort to put in anymore, but part of their estate plan is to leave that asset to their children. They want to benefit from the 1031s. They could roll into a DST or a passive asset where they can wait until, mom or dad passes away. The kids will get a step up in basis. There's no tax. There's no estate tax. So 1031 has some really great applications. But what I find for a lot of the clients that I deal with, which are, successful entrepreneurs that are making good money, 7-figure incomes, they put 250 into a deal. They put 500 into a deal, and that deal's done really well. And now their money's worth $2 million. And then they rolled it into another 1031, and now that money's worth $4 million. The challenge they start facing is that one asset becomes a significant portion of their total net worth. And in order to continue to do those 1031s, they've got to continue to concentrate all of that wealth into one individual asset. And that by itself presents its own problem, because we all know the adage, we don't want all our eggs in one basket. So I'm an advocate for oftentimes breaking up that investment in the year of a sale into multiple LP investments, where the sponsor is going to be doing a cost segregation study, and you'll receive anywhere from 75% to sometimes 125% of your equity investment as a depreciation deduction. So let's say you sold that asset for $2 million. And you broke that up into 8 investments at $250 each. And as a result, you're receiving K1s that are going to pass through depreciation of, let's just say, $1.5 million. Well, now you're only going to pay capital gains tax on that $500,000, the difference between the $2 million capital gain that you had and the $1.5 million of depreciation you took. but you now got a step up in basis. You've diversified your assets. You've been able to maybe enter different markets or different types of asset classes so you can reduce your risk and increase your potential future liquidity without kind of kicking the can down the road on this huge embedded tax that you or your heirs might face.
Could you just break that down a little bit more there? Just that process that investor just went through. So he had a what, 500,000, I think you said, or 250 invested, and then after a few years, it's 500, or a 1031 now it's 2 million. Okay, now what happens? He does actually sell out. Is that correct?
Yeah. So when you sell, you have the option to, if you're going to do a 1031 exchange, you've got 45 days to identify your asset, and then it's like 90 days to close on that asset. I forget the specific day counts, but basically a clock starts ticking on you.
Right.
The downside of that clock ticking on you is oftentimes people are making suboptimal investments because they've got that time pressure, and it's like, I better just get the deal done because I don't want to lose my tax deferral. And I see that same sentiment oftentimes with these opportunity zone investments, and maybe we could talk about that a little bit later, where people are making suboptimal investments in order to attract a tax benefit. But when you sell an asset in a given tax year, if you invest in other real estate projects in that same tax year, you'll receive all of the depreciation benefits for that tax year in the year of acquisition. So it's a little bit more difficult. We're facing, the last few months of the 2020 tax year. If you're going to have a sale in September or October, you might be better off with a 1031 transaction because it'll be hard to identify the number of investments you need to make for an alternate strategy to offset your taxes. But if you have a closing in January and your proceeds come in January, you've got 12 months to reallocate that capital into new investments that would benefit from a cost segregation study and benefit from accelerated depreciation, which would offset your gain. So I'll give you an example. We closed on a deal in November of last year, and it was a pretty plain vanilla deal for us. There wasn't a lot of heavy lifting to it. It was maybe $1 million of CapEx improvement on top of an $8 million acquisition. But in that particular deal with our cost segregation study, we bought it middle of November. The K1 comes out, December 31st. So we only own the asset 6 weeks, and everybody got 75% of their initial investment passed through as depreciation losses on their K1. So for someone like me that's an active real estate professional, I'm able to offset 75% of my investment against my ordinary income from my other businesses. That's a huge advantage. Now, for someone that sold a property in 2019 that invested in that property with me with their gains, they offset they offset 75% of their taxes that they would have owed, and they still paid the 25% in capital gains tax on what was left. But the advantage is they now have a step up in basis in this new asset. And I think as we're looking to this next election and doing what I call Biden proofing your taxes, you want to start thinking about what are the potential tax laws that are going to impact your personal financial situation and how might you plan around them. And one of the things they're talking about is taking away Section 1031. One of the things they're talking about is a wealth tax where you'll pay a tax every year on the value of the assets that you own. And so some of the strategies we've been relying on for decades, we want to make sure that we've got a plan B in case they're not around when we need them.
Could you speak to that just a little bit? If you're aware of them like taking away the 1031 option, I've heard that just briefly. Have you read anything about that or what to expect?
There were some news articles that have come out in the past few weeks with Biden's plan, tax plan, and part of his tax plan is eliminating some beneficial real estate tax treatment. Trump's presidency has done a lot to foster real estate tax situations, and it's not surprising given his own personal circumstances that he would enact tax codes that would favor his family. So I think there might be a little bit of a role reversal with the next administration if it's Biden led. And if it's not, it's like the warning signs are all there that anytime we do tax planning we want to look at the existing tax code, but we also want to think backwards and think about what's happened in the past and how might that impact our future. The same way we do when we're making any investment, we want to look at the past performance is not indicative of future returns. The history doesn't repeat itself, but it often rhymes. So the same thing is true with tax law. And we've gone through periods of time in the US where our highest ordinary income tax rate was above 80%. And for most of the second half of the last century, that tax rate averaged 60%. So right now we're still living in this historically low, high income tax bracket being under 40%. And I think we've gotten accustomed to living with a highest tax bracket under 40%, but it's not unrealistic when we look at our debt, when we look at the just sentiment that's going around culturally between the wealth gap that exists between our highest income earners and our lowest income earners and how disparate it is, that a 60% tax could help make up for some of that difference.
All right. Yeah, I'm grateful for that explanation. Thank you for going into that. And I just think it's very educational for a lot of people listening, including myself. Just, if you haven't been taught to think that way, look at the past and what's happened with taxes and numerous things, just like comparing it to your investments and thinking forward, right? And having an exit plan and a plan B. But let's move into just some general taxation stuff and taking most advantage, the most advantages possible for the passive investor. And I think you can speak a lot to that as well.
So I think one of the predispositions I had, because I was a practicing accountant, I'm a third generation CPA, as you mentioned. My father had an accounting firm that I was a partner in for a decade. My father-in-law is a practicing tax accountant. This is the type of dinner table conversation we had was around the tax code. And, that's somewhat unusual. So one of the things I learned early on is that the uniqueness of our tax system is that it's self-reporting. So although a lot of people report to the government through different forms, like, our K-1 that we receive in an investment, it's provided directly to the IRS by the company that we invested in. But then we take that K-1 and we have to report it on our Form 1040. People sometimes issue a Form 1099 if we collected interest. So they're reporting that to the government and then we report it on our 1040. A lot of the things that we do as individuals and as owners of enterprises is not reported directly to the government, and the government's relying on us to self-report. And so because we're self-reporting, we get to make our own judgment as to what is it that we're going to report as income, what is it that we're going to report as expense, and how do we classify that. And the way that our system responds to that is by, if they have a question, the IRS will write you a letter and say, dear taxpayer, you took this deduction, or we believe you had this income. Can you please verify by providing us with your evidence? So because of the nature of the way that we report, it gives us as taxpayers a lot more freedom than other tax jurisdictions where the government tells you exactly how much you owe. They complete the forms for you because everything's being reported on your behalf. And so we want to use that flexibility to our advantage. We want to come up with ways that we could consider expenses to be business expenses, or ways that we could consider our activities to qualify us as real estate professionals. So for individuals that are investing either as an LP, or maybe sometimes they have a few units that they own directly and then they're making LP investments with other sponsors, if you can become a real estate professional, which doesn't require you to have a real estate brokerage license, but it does have other certain requirements, then the government allows you to deduct all of the depreciation from all of your assets against any other ordinary income you have. That's a massive advantage. And so if you're listening and you've been actively engaged in the investment in real estate, but you're not currently a real estate professional, maybe you're still at a job that you get paid every 2 weeks and you receive a W-2 at the end of the year, that doesn't preclude you from being a real estate professional. And you want to be sure you're talking about that with your accountant and figuring out if there's some way that you or your spouse could qualify as a real estate professional.
And it's I'm glad you just mentioned you or your spouse. I mean, it's potential that if you don't qualify, maybe your spouse does.
Yeah. And we see that a lot of times. You've got maybe a doctor or a lawyer and their wife is predominantly a homemaker, But if we can get them to classify as a real estate professional, it might be able to save them $50,000, $100,000, $150,000 a year. So if we could keep a journal of the wife's activity looking for property every week, if we could keep a journal of the wife's activity interacting with tenants or discussing investment properties with their spouse or with their financial advisor, with their accountant, then we could start to build up their resume as a real estate professional.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm, Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. So what about thinking outside the box a little more? There are ways that you've seen for people to be able to find expenses that they can count as business expenses that we may not typically think of.
I think there's a lot of things that we miss when it comes to the tax code, and it's not really the fault of our accountants. The accounting profession in general has been taught how to look very clearly through the rearview mirror and make out all of the details of what's happened in the past, but we're not taught to look out of the windshield and see what's coming. So as a profession, we're not incentivized to help taxpayers think about how do we avoid future taxes. We're only paid for the return preparation in almost all cases. And I just had someone that approached me about doing some tax planning, and I told them to go back to their CPA firm to do a tax projection. And they were so miserably upset because the accountant just took their 5 months worth of numbers, multiplied it by 12/5 and said, here's your year. And, it was like, there was no thoughtfulness, there was no advice, there was no counsel. And I think that's happens all too often in this industry. So be sure that if you're not getting tax advice from your current tax preparer, that you have someone else in your life that's helping you focus on how do we avoid future taxes, not just present day taxes.
That was going to be something I wanted to ask you. You triggered in my mind there, even just, hiring a tax strategist versus, hiring our CPA or accountant, somebody that we're speaking with, often, about what's happening in our finances and our taxes. But, should we hire somebody that's an actual tax strategist, and then also, does that person then say, do our taxes, or are they just more an advisor that will help us work with our current, CPA?
Yeah, I found that in most instances, really good tax strategists make a lot of money. And because they make so much money, they're not good people to do tax compliance, because tax compliance is in some sense a commodity. Recording history is not very valuable. So most tax strategists, either they don't do the preparation themselves, or they don't even do it inside their firm. So you may work with a tax lawyer, you may work with a wealth manager, you may work with an estate planning attorney, someone that's maybe a little bit more sophisticated just on taxes, but not handling the preparation of your Form 1040 for your personal return, or not handling your business partnership returns. We want to let somebody at a low cost do that type of work. And when it comes to the real creativity, critical thinking, that's the stuff where maybe we're paying $1,000 an hour or $2,000 an hour to someone who's incredibly brilliant. And we're not paying them for the hour that we're spending with us. We're paying them for the 20 years that they've spent learning exactly what to do with that hour.
Very well said. That's with a lot of professions, right? When you're hiring somebody that's a professional advisor, it's well worth it. It seems like a lot per hour, but it's well worth it because of their experience. So,
Yeah.
What about, I hear about this, you getting the 4% tax rate on your income, and I'd love for you to elaborate on just structure, how you've structured this to accomplish that. So, maybe we could think the same way.
Yeah, so bear with me, because I'm a bit of an egghead in some sense, that I love exploring the tax code and I love finding ways to beat the system. It's the game that gives me a lot of pleasure. It allows me and enables me to take the capital that I'm creating and use it in a way that justifies what I'm working for. And that does include causes that I care about. and contributing to things that I want to make a difference, but I don't enjoy funding our government. So I came up with a strategy that's quite unique. Puerto Rico came out with tax incentives a few years ago. The island of Puerto Rico had really great incentives for pharmaceutical companies to come and manufacture their drugs there. And they started that in the 1980s, and they built dozens and thousands of jobs in the pharmaceutical space, in pharmaceutical manufacturing. And then they took away those incentives. And what, lo and behold, all those companies left the island. And so they looked around and said, oh, I guess that wasn't a good idea. Well, what could we do now? And they said, let's try and invite entrepreneurs to set up their business here and for retirees to come live on our island to enjoy their retirement. And they came out with two significant tax codes, which were formerly called Act 20 and Act 22, now commonly called Act 60. And what they did for businesses is they said, if you come and open your business in Puerto Rico, we'll agree for 20 years, we'll only charge you a 4% corporate tax rate. So think about that. Right now, the IRS is currently at a historic low corporate tax rate of 21%. Certain states apply an additional tax rate on top of that. But Puerto Rico is saying 4%, that's all in. You don't pay IRS federal taxes when you're a Puerto Rico-based business. You don't pay any state income taxes when you're based in Puerto Rico. So I like that. I thought that was a unique incentive. And so I went and set up a company in Puerto Rico with this 4% tax rate. But I did one extra thing, because a corporation, when it issues a dividend to a shareholder, that shareholder has to pay dividend income tax. And if you live in Puerto Rico and you receive a dividend from your Puerto Rican company, you don't pay any tax. Puerto Rico exempts it. So my brother, who operates our business there, he's a Puerto Rico resident. He operates a Puerto Rico business that he owns. He receives a dividend. It's tax-free. So he has a 4% effective tax rate on his earnings from our company. Me, on the other hand, I live in South Florida. I'm embedded in our community. I've got young children. I really like raising them here in our suburban environment, and I didn't want to move. That wasn't appealing to me. So what I did is I set up the ownership of my company inside of a Roth 401k plan. Now, the benefits of a Roth plan, for the listeners that don't know, is that we pay tax on the money going in, and we never pay tax on that money again. So when I set up that company, it didn't cost me very much to set up. I made a small deposit into my 401k account. I paid some tax by converting it to a Roth. And that company now owns the majority of my Puerto Rico business. So when we have, let's just say, $1 million of income, we pay $40,000 of taxes. $960,000 goes out as a dividend distribution. I pay no tax on that dividend. It goes into my Roth 401k. I can invest that in real estate. I can invest that in the stock market. I can make private loans. All of the interest, dividend, and capital gains on those investments are tax-free. And when I turn 59 and a half, I could take as much or as little of that money out as I want, also tax-free.
Awesome. I have not heard that one on the show up to this point. Over 650 shows. Wow. And very interesting. So you're not a resident there, but you can still, you can still have part ownership in a business there that's achieving the same results.
Exactly. And I think for a lot of people that want to continue to live in the continental United States, one of the things that's a challenge for a lot of municipalities right now is that their revenues are going down. The state's revenue is going down, and people are mobile. So if you live in, Illinois, and you're in the city of Chicago and you're paying a high tax rate, well, maybe you're going to move across the border to Indiana. Or if you're in Manhattan and you don't want to pay a high city tax, you can move out to the Westchester suburbs and just pay your New York state tax. And then some of the people in those high tax states, whether it's California, New York, or New Jersey, they're saying we want to leave and we're willing to go to a place like Texas or Florida where there's no state income tax. But not everyone's willing to make that leap to Puerto Rico and live on that island. So you could still do things to escape taxation, even if you're not willing to move your tax residency.
Does it have to be in a 401k plan?
No. I found it to be very efficient for me. because of the way the tax laws are structured, but you can set up corporations in different states and operate them in different states. And there are ways to create arbitrage. If you're a California resident, but you want to start a business in Nevada where there's no tax, or you're a New York City resident, but you want to set up your business in Florida, you can do that. And now that everyone through this pandemic has realized that they can still be productive. Maybe it's not equally productive to commuting Monday through Friday, 9 to 5 to the same space to work with all the same people. But if you're able to work remotely and that doesn't impact your productivity so significantly, then there's more incentive to, re-domicile your business in a more tax favorable jurisdiction.
Nice. Well, at least that gets us thinking that way, right? And now I feel like the listeners and myself have a lot of research to do, just to discover or dig into that a little further. And I know we're almost out of time now, but just a couple more questions, Noah, or anything else about just the tax strategies that you want to share with us before we have to move on?
I think the most important thing is that if you haven't had a second opinion on your tax return in the last 3 years, go get one. Any accountant is willing to give your return a second look at no cost for the potential that they could give you some good advice and that'll woo you over to become their client. And we could always go back 3 years to amend tax returns. I had a friend approach me recently. He asked me to look at his returns. I was able to get him $150,000 in a tax refund from prior returns where his accountant made an error. He's thrilled, and that didn't really cost him anything. So make sure to go ask for somebody's advice. Just to put it in context, our company works predominantly with high income earners. So we really started around taxpayers paying $250,000 or more in taxes. So the 7-figure earners is kind of the low end of our business, but you'll get good advice just by shopping around and getting a second opinion. And if you get nothing out of it, then your accountant's doing a good job and there's no motivation to do anything different.
So what do we need to have with us when we go and approach that person? Is it just like our previous 3 years tax returns, or is there anything else?
Start with your previous 3 years tax returns. If you're kind enough to create a bit of a narrative for the accountant, it'll help them. Give them a little memo that just walks through how your business has evolved in the last 3 years and where you are today, and maybe a little bit about where you're going. And that way they could start thinking through, okay, well, if I were in their position, maybe I would set up a new entity and here's what I would use that new entity for. Or I'd start thinking about ownership being split between myself and maybe myself and my spouse, or myself and another entity that's going to own my interest. And if you give them some information, hopefully they'll brainstorm some good ideas.
Nice. Well, grateful for that. And yes, I hope the listeners are taking that to heart and really finding somebody that can give them a second opinion. It could be so worthwhile. Like you're talking about your friend, 120,000, that makes it it makes it worth so much to pay somebody, right? For even that opinion if you have to. So a couple last questions. No, I know we just talked about a few of these, but we'll talk about a couple of them again, because I think they're important, but just like the number one thing that's contributed to your success. What would that be?
I think the last answer I gave was around learning. And I think that's definitely my number one. I'm always learning. I'm always reading. I'm always listening. I'm always interacting with people that have unique, novel ideas or approaches to the world. And I think our education can't end when we get out of high school or college or graduate school. We've got to continue getting educated. And the best investments I make are $20 books, because I get a lifetime's worth of wisdom from someone that's willing to concentrate that down into a couple of hours on Audible for me, and I could get their best learning lessons.
Do you listen completely, or do you have the hard book as well? What's your best way of absorbing?
I'm about 99% audio at this point. I really don't enjoy reading with my eyes. And I found that by reading with my ears, I can accomplish a lot more. I'm an auditory learner, so I process it much more effectively. And then I also have the benefit of multitasking, which is good for my ADD. So I'm usually out for a walk and listening to a book, or maybe even just laying in bed next to my wife when I wake up early, and I can put my headphones in and listen to a book while I lay there quietly. So I've found that reading with my ears has been a real blessing.
And how do you like to give back?
So my wife and I have a family foundation. We focus on education, food security, and Jewish causes. So we like to give our time and money to organizations that are focused around those three impact areas. And then on a personal level, I do a lot of mentoring. People often come to me and approach me, with, hey, Noah, can I pick your brain? And so usually I try and organize those calls for the weekday mornings when I'm out for a walk. And again, try to multitask where I could give someone some good advice and mentorship at the same time that I'm doing something good for my body.
Nice. Well, grateful for you sharing that again, Noah, and just how you want to give back and give back in that way. And just, I feel like you've given a lot to us today, just on taxes specifically. Just get us thinking outside of this box that I feel like a lot of us are in, or that I can get into, and just having that second opinion, the value of that. Tell the listeners how they can get in touch with you and learn more about you.
Sure. So if you're interested in real estate syndication, go to investwithourfamily.com. That's our syndication platform. If you're a very successful entrepreneur that's thinking about how you want to convert your net worth into passive income so you could enjoy your life to the fullest, you can visit us at freedomfamilyoffice.com. And then for those of you that might not have heard about the power of royalties, I've got a new company that I'm in the process of taking public, which is really exciting, called Fiji Royalty, FIGI royalty.com. And it's a unique novel business where we acquire revenue royalties in internet-based businesses. And we're right now open for a 506c investment.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.